Are growing housing foreclosures a sign of a coming housing market crash? We'll be looking at the latest New York Fed report today. Housing inventory is falling as demand continues increasing, and this week we had 15.5% more homes go under contract compared to last year. That's a huge jump. And after 40 days of being shut down, the United States Senate has finally advanced a bill to fund the federal government until January 30th. Now the Senate still has to pass the amended measure, then it has to get approved by the House of Representatives, then sent to the President to sign, which could still take several days, but it looks like we're pretty close. Which is great news because as of now, we're still missing 2 full months worth of jobs reports and unemployment numbers. So once the government opens back up and these reports get released, we're gonna have a much better idea of what's gonna be happening for mortgage rates for the rest of the year. If you're an investor who wants an insanely discounted new build, I've got a home for you that was selling for $460K just a year ago. And because this builder is now on closeout, they only have 8 homes left, they will sell you that exact plan today for just $385,000. So I'm gonna show you that one, and then I'm gonna show you 3 really great new listings I have coming to market this week. So we're gonna be covering all of that and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends, we're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, today is November 10th. Let's see what the data is telling us, and if this is an old video, you can click the playlist here to get to the latest weekly market update. Okay, starting with market news. The guy who runs the little cafe here at my office where I get my lunch every day, he stopped me last week asking about foreclosures. He said he saw somewhere in the news that there's a huge wave of foreclosures that he's got to be scared of. So just in case any of you heard that same news, today we're covering the latest New York Fed household and credit debt report that we just got. And spoiler alert, homeowners in America are in as solid of financial shape as they have ever been. If you hear anyone at Thanksgiving talking about this is 2008 all over again, I want you to share this video with them. Actually, I'll probably make this segment a standalone video so it's easier to share. But what we have today is the best financial middle class that the world has ever seen. And a big part of that is thanks to the 2010 qualified mortgage rule that made it much harder to get a mortgage. So let's start with those big scary foreclosures. Here is the scary foreclosure chart. Foreclosures and bankruptcies are still below pre-pandemic levels, and you can just quickly look at the chart here. You can see, let's see, here you have all the 06, 8, 9, 10, 11, and then we were coming down pre-pandemic all of these years, 16 to 19. You can see the line was up here. You can see we're still not up to there, and you can see the bankruptcies were way up here above this line. So to be pre-pandemic, bankruptcies would be up here, foreclosures would be about where the bankruptcy line is, or a little lower, about right here. But you can see we're still not even to pre-pandemic levels. So how can anybody look at this and think there are a ton of foreclosures coming? Well, what they do is they look at these COVID years when there were no foreclosures because a lot of them were deferred. Plus, home prices were just going straight through the roof, so there was really no need for them. If you went underwater, you could just sell your house, you'd make a ton of money. So they take all of this tiny data where there was nothing, and then they zoom into this next area and go, foreclosures are up 300%. There's this huge wave of foreclosures. But that's what you have me for here, is just to zoom you out and show you we're still not back to where we were before the pandemic. What really happened is we went from 0 foreclosures to trending back towards a normal market environment, just like the rest of the housing market is doing. There's nothing scary about this, and I'm certain you can look at this chart for yourself and see that. And in fact, we've experienced many recessions since World War II, but only one time did we face a foreclosure crisis. Just one time. But the most significant difference between this and the 2008 market is that current homeowners have a ton of equity in their homes. Just look at this chart. Down payment percentages are at 21st century highs today, where during the housing bubble crash, over 23% of homes were underwater. You see how this bottom red bar keeps going higher and higher and higher? These red bars are people who have greater than 40% equity in their homes. So as of now, this bar means 70% of homeowners have greater than 40% equity in their homes, meaning that rather than face a foreclosure, they can simply sell their home. So literally 70% of the housing market would simply be able to sell their home instead of facing foreclosure unless a greater than 40% price crash were to occur. So unless you think a greater than 40% price crash is coming, there's not going to be a wave of foreclosures because 70% of homes have more than 40% equity. And as of today, this little tiny gray bar that you see right here, that is the 3% of homes that have less than 9% equity. Only 3% of homes have less than 9% equity. But it gets better. Let's look at the next chart. These are the loan to value ratios over time for US mortgages. During the housing bubble crash, the loan to value ratio was around 85%, meaning the average home equity people had was only around 15%. Today, it currently stands at an incredible 44.2%, which means the average homeowner has 55.8% equity. And this number is different from the last one because 40% of homes don't even have a mortgage. So that last one was just covering mortgages. If you just look at all the houses that people own, the average homeowner has 55.8% equity in that house. So think of this chart as the size of the loans that people have. They used to have 70% of their homes were on loan, and now on average, it's only 44.2% of their home is on the loan. Do you guys see how big of a deal this is that in 2013 it was over 70% and now it's down to 44%? That's so much more equity. And as part of this report, we also can see the updated FICO score data for US homeowners, and this chart alone shows you just how much more responsible homeowners are with their finances. You see how these gray bars, you see there were barely gray bars back here, and now they got bigger and bigger. Look how huge this is, and even now, the majority of this bar is just the gray area. Those are people with 760 plus credit scores. So looking at this last bar just for this quarter, only $18 billion, this tiny, tiny sliver at the bottom, only $18 billion of loans went to people with less than a 620 credit score. The next $22 billion went to 620 to 659 credit scores. Then $58 billion went to 660 to 719. So all these three bars, these are all the people with less than a 720 credit score that got loans. You can see that is almost nothing. Then the people from 720 to 759 credit scores, 76 billion went there. And the majority, this large gray bar, $338 billion were lent to people with 760 plus credit scores. So looking at 720 plus credit scores, these two bars, that was $414 billion. And all these down here were only 98 billion. That's people under 720 credit. That means 76.3% of loans went to people with a 720 plus credit score and only 23.7% to those under 720 credit, which looks nothing like it was back here before the '08 crash. And then lastly, just for fun, even with mortgage rates getting as high as 8% over the last few years and just now getting back to the low to mid sixes, 70.4% of mortgage borrowers still have mortgage rates of 5% or below. And for everyone who still has a mortgage rate over 7%, you're finally going to get to refinance sometime next year under 6%. I believe that. So guys, homeowners have significantly more equity and are way more credit worthy than they have ever been. Anyone trying to scare you with foreclosures either doesn't understand data or they're just lying to you for clicks. Either way, be careful who you listen to online. Getting lots of views does not mean you have any idea what you're talking about. Scary content will always go viral, even if it's not true at all. People love panic sharing without fact checking. They just love it. Okay, now we're moving on to my property showcases for the week. First up, if you're an investor, I don't know why this picture is so low, but if you're an investor who wants an insanely discounted new build, this one just came across my desk, which is why I've only got these photos and no video yet. But this exact house was selling for $460K a year ago. And in fact, even the last 5 sales of this plan, they sold between $416 to $453. So even recently, one of these sold for $453. But now this builder is on closeout and they want to sell this community out in the next month. So they're discounting all of their plans like crazy, and they will sell you this beautiful over 3,000 square foot home today for just $385,000. And as usual, the builder pays 2% of the purchase price towards your closing costs and your title policy. It'd be a little less than a $10,000 incentive. Your total cash to close would be just under $100,000, and your monthly payment, including taxes, insurance, and HOA, would be about $2,800 a month. This plan will easily break even as a rental, and I would be surprised if you can't get $3,000 or more for it. This is a 5-bedroom, 3 full bath, 3,050 square foot home just 15 minutes from downtown Fort Worth in a fully developed area, and they're literally building a super target right outside the neighborhood as we speak. I mean, just look at the size of this game room. It's a huge house. I know one of you investors is out there lurking and all you care about is getting a massive discount. Again, this was selling $453 even recently, $460K a year ago, $385K for you today for 3,050 square feet for a 5-bedroom. So one of you better call me and get this one. And then I've got 3 killer listings coming up this week. This first one is a fully renovated 1940s colonial revival in my absolute favorite neighborhood of Dallas. This is the Lakewood neighborhood. It has a massive lot, which is nearly impossible to find in Lakewood, almost 1/3 of an acre. And they've already got plans if you want to expand the house off the back to make it a 4-bed. A lot of the people inquiring about this so far have been young families with maybe 1 kid, and they don't want to pay for or need the extra space right now, but they want to be able to add on later without having to move. So it's already got the plans for that. Also, this one is on Gaston, which is a busier road, but if you just walk out the back gate, you can access the neighborhood, so you can go on walks or ride your bike around the lake. If you want to see how beautiful this neighborhood is, as well as a full tour of this house, I'll put a link here. But this one is listed at $1.33 million, and that's the price it appraised for after the renovation. It just listed on Thursday, and we have had a lot of interest. It's got 3 beds, 2.5 baths, it's 2,379 square feet, and literally everything on this home has been redone. Next up, this one is going to be listing this week somewhere in the mid-400s. It's a 4-bed, 2-bath, 2-car garage, super cute, perfect starter home here in Richardson, Texas, which is the very first city north of Dallas. So it's only about 16 miles to downtown Dallas. And the most important thing you need to know about this house is that it recently got rezoned into Mohawk Elementary, which is a 10 out of 10 rated elementary school. Before this year, if you wanted to be zoned to Mohawk Elementary, you'd be spending a minimum of $600K to buy a home in the reservation neighborhood, where new construction homes are regularly selling north of $2 million. So now, this year, there's this tiny corner of the Greenwood Hills neighborhood where you can buy a great starter home like this in the 400s and still get that 10 out of 10 rated Mohawk Elementary School. So if you know someone who wants to be close to all things Dallas in an incredible elementary school in the 400s, please tell them about this one. And I'll be posting the longer video tour later this week. Then last but not least, if you want to be walkable to luxury shops and restaurants and have a single detached home in Dallas-Fort Worth with no shared walls under $1 million, this is one of the few places you can do it. This one has 3 beds, 2.5 baths. It's just under 2,100 square feet, and we'll be listing later this week as well, somewhere in the mid-900s. It's literally directly across the street from all the luxury shops and restaurants of Plano's Legacy West development. So if you work at Legacy West, you could walk home if you lived here. And if you're interested in the furniture you see here, the seller is willing to part with all of it for the right price. So if you know someone looking for this, send them my way. All right, that was a lot. So let's finally move on and start with national housing inventory. This week we had a decrease, this big drop here of 14,459 less homes for sale in the country, which for me very clearly marks the start of our seasonal decline. I thought that this was our peak way back here at the beginning of August. I still think that. I think the data got very skewed these 2 weeks thanks to Amazon Web Services. But either way, this only broke that peak by a few homes. So for me, I'm still counting the inventory peak way earlier in the year back here in August compared to what is normal would be about this time of year. But we were totally flat, and now it's pretty obvious this is our seasonal decline. And this drops us to 16.73% more inventory than we had last year. Remember, a few months ago, we got as high as 33% more inventory than last year, and now we're down to 16.73. But we have 842,242 homes available for sale in the country, and this same week last year, inventory was only at, that's way down here, 721,576. So way better than last year. And you can see this gray line is just about what would be a normal market. That was 2019. If you took the average, it'd probably be a little higher than this, but we are almost back to pre-COVID levels of inventory. Then for reference, back here in 2022, we only had 240,000 homes for sale. The peak of last year, we had 739,000 homes for sale. Then looking at new listings, this week looking at this dark red line here, we had a bounce of 4,654 more new listings than we had last week, which is actually 6,618 more than we had last year. That's this jump between the bright red and the dark red up here. We're pretty much exactly where we were in 2023, but really, I don't expect anything to change too significantly here in the end of the year. I think we're going to trend in a very tight range all the way down. Whereas you can see at the beginning of the year, we had some months here with a lot more new listings. Then we started lagging behind 2022. And I mean, we've just barely been above the previous few years. And outside of this big anomaly, again, that was Amazon Web Services, straight up, straight down. If you average it out, you would have just gone straight across. But yeah, we're going to be in a very tight range here, I would expect. And all you really need to know about this is from now till the end of the year, there's going to be less and less new listings to choose from every single week. So if you find a great house, do not wait thinking that a better one's going to come on next week, because there are going to be less and less new listings every week. But this week we had a total of 55,481 new listings. Now moving on to weekly pending sales. These are just new single family contracts this week. And it's the same story as every other chart. We had Amazon Web Services, got really weird. If you just average it out, we were basically at the peak of this last year's line. So just ignore the big spike up and down and just think it's pretty much going across. But this week, new contracts increased by 3,933, which also gives us 7,968 more homes contracted than the same week last year, which is actually 16.5% more new contracts compared to last year. So this is actually a pretty huge jump. We'll have to see what happens in the next few weeks. But again, I think the last 2 weeks were skewed because of Amazon Web Services. I think they should have been more sideways. So even if it looked like more sideways and then just this one here, it's still a huge jump. And I would say here at week 3, the data should be reliable again. But that's a total of 59,245 new contracts, single family this week. The last thing we cover nationally is a percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling. Looking at the national chart, we decreased 0.2% this week, which means very little change for the 9th week in a row. All of this is basically sideways. And that makes for 41.7% of homes took a price cut this week. And as you can see, we've been falling very close to last year, this bright red line's trajectory. So you can just expect we're going to start curving down like this through the end of the year. But last year we got as high as 39.9%, the year before 39.2%, and in 2022, when mortgage rates went straight up to 8%, we got as high as 43.2%. And just so you know, if you want home prices to continue down, this number would need to be going up, and it's obviously going to start coming down for the year. So we're going to see less and less price reductions. Now moving on to mortgage rates, we had another very stable week, and a lot of this is because we have no new data to go off of, so everything's just kind of frozen. But we started at 6.34, got up to 6.37, and ended at 6.32. So beginning to end of week, we had a 0.02% drop, and then year over year, we still have 0.66% lower mortgage rates than we did this day last year. Then looking at mortgage purchase applications, this week we had a decline of 1% week to week, but that still puts us this huge gap at 26% year over year gain in the number of people applying for mortgages this week, which gives us 37 straight weeks of positive year over year growth. So it's obvious a lot more people have been applying for mortgages pretty much all year, but I've been saying it for more than a year now, this is still very suppressed demand. And there's no reason to believe that demand is going to grow significantly with rates even this high, not until they get and stay below 6% for a sustained period of time. But we're getting closer, and I would expect sometime in the middle of next year is when that's going to happen. All right, that's it for the national market. Now looking at the local markets, we're starting with the MLS data of Dallas County. Starting with Dallas County, we had only 504 new listings. That's the same as 2 weeks ago, but yeah, we went up 13 last week and straight back down 13 this week. We only had 247 closings. That's 93 less than last week. Now remember, closings are contracts that happened about 30 days ago, so whatever happened 30 days ago, we had a lot less contracts then, and now they're closing. So 93 less closings than last week. And then of the homes that closed, 30 were immediate sales, meaning they contracted within the first week. That's 11 less than last week. And new contracts this week, we actually had an increase of 24 up to 263 new contracts this week, which is about as high as we've been for over a month, other than this one anomaly week where we hit 308. 263 is right in line with everything you see here. And in total, there are 1,930 homes either under contract or pending. That's 11 more than last week. Now looking at the same numbers for Collin County, we had 352 new listings, which is a big drop of 60 less homes compared to last week. 352 is definitely lower than usual. We've had a lot of weeks above 400 recently. We only had 220 closings. That's 62 less than last week. Again, that's from 30 days old data. Of the homes that closed, only 25 were immediate sales. That's 17 less than last week. We only had 146 new contracts. So unlike Dallas, where the contracts are still in line, we actually had a 31 home drop in new contracts. And that's, other than this 1 week, 146 is the next lowest number. We've had a lot in the 160 to 180 range. So low contracts in Collin County this week, and in total there are 1,763 homes either under contract or pending, and that's 40 less than last week. Now we're moving on to the Market Action Index, starting with Dallas County. If you've never seen this, it takes into account all of this data, puts it into one easy to read graphic with a number over here. Anything at 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in. We're currently at a 34, which is a slight seller's advantage. You can see the overall trend is down. Oh, and all we use this for is just to see, are things looking normal or is anything looking unusual that we should be aware of? What should be happening this time of year is things should just be cooling off basically from now until January, just a slow, steady cooling. And that's what you see in the Market Action Index. Actually, this week we went up 0.01, so we just went sideways now. That's normal for this time of year. The most unusual thing that we've been seeing is home prices have not been able to break below that 400,000 median list price. We had that low back on August 22nd, and we've been basically just going straight sideways. We're back at it this week at 400, but that's unusual, as you would expect prices to have gone down a little bit more. And they still might, but they've been holding more firmly than they usually would. That's the unusual part. When it comes to median price of new listings, though, you can see we had a jump down on August 22nd, and they've pretty much just been going sideways as well. So at 374.9, they're nowhere near the bottom of 366. And again, that's unusual. You'd expect prices to be going down at this time of year, and they're not really. Average days on market actually remained totally flat. It looks like it went down on this line, but it says it went totally flat. Maybe that's like a rounding thing. Median days on market actually ticked down though, from 77 down to 70, and this line only goes in 7-day increments. So yeah, I would say this line does look like it's going down. This probably should have said 105, but median came down this week to 70. Who knows what it'll be next week? It seems like it's right on the edge there. Homes having price decreases, looks like it peaked back in August, pretty much like the national chart should have, and has been trending down ever since. We're down to 47.26% of homes taking a price cut. Inventory is almost back to this bottom that we had on September 5th. It had a bounce and it's coming down quickly. We're down to 5,891 homes here. And once again, the Market Action Index basically remained flat. So nothing is really looking unusual. Prices are a little more firm than they should be, but that's just because rates have come down here at the end of the year. Looking at Collin County, it's a little bit softer. It pretty much always has been. It's a 32 slight seller's advantage, and their median list price held firm for a long time, but last week it did come down to about 519.9. It remained totally flat this week. But again, normally you would expect prices to trend down, not go so much sideways and then a little bit down. And same with median price of new listings. It did have a new low last week, but it bounced right back up into this sideways range that it's been in. So still, prices are holding pretty firm. Average days on market here went up by 1, and their median jumped up another 7-day increment up to 84. So you can tell it's definitely a little bit slower than Dallas County. Price decreases quite a bit higher than Dallas. Dallas was 40 something, they're 55 here, but you can also see mid-August was their peak and they've been trending down. Their inventory as well had a pretty big drop this week. So nationally, Dallas and Collin all had pretty sharp drops in inventory, although Dallas was definitely sharper than this, but they're down to 5,724. And their Market Action Index actually had more of an actual bounce this week, but again, you can see the trend is clearly down, and that is normal for this time of year. Now we're moving on to the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. These are ranked using that same Market Action Index number we just discussed. Remember, 30 or below is a buyer's market. The absolute hottest market has been for some weeks now and remains Hutchins, Texas, at a 39.99, followed by Grapevine and Coppell. Those remained. Irving heats up 3, Carrollton cools off 1, Lancaster cools off 1, DeSoto heats up 1, Plano heats up 1, Grand Prairie cools off 3, and Cedar Hill jumps onto the list, replacing Richardson last week. Then we like to zoom into specific zip codes. The absolute hottest is a 46.96, that's Irving 75061, followed by Dallas 75234, Plano 75093, Hutchins 75141, Dallas 75206, Grapevine 76051, Louisville 75077, Dallas 75249, Lancaster 75146, Grand Prairie 75052, which is a 38.26. So if you have a home in one of these zip codes, you should be able to sell for top dollar. I think it's interesting how quickly some of these zip codes are heating up. That's definitely not normal. Now looking at the same thing, but the coolest cities and zip codes. This week, Nevada takes the coolest spot, so it cools off 1 and Whitewright heats up 1. They switch places. Then Anna and Royce City remained. Salina cools off 2, Prosper heats up 1, Rockwall cools off 3, Blue Ridge heats up 2, Leonard remains at 9, and Farmersville heats up 2 to become the hottest city on the coolest cities list. But keep in mind, all of these are below a 30, so these are all buyers markets on the city level, and then same with zip codes, these are all buyers markets as well. So the absolute coolest is Nevada, 75173 to 26.65, followed by Whitewright, 75491, Anna, 75409, Dallas, 75204, Royce City, 75189, Salina, 75009, Rockwall, 75032, Prosper, 75078, Rockwall, 75087, and Irving, 75039. So these might be where to look for an opportunity as a buyer. As always, if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. Call, text, or shoot me an email. All that info is in the description below. Thank you for watching. I'll see you in the next video.